Take a screenshot of this one. This is solo 401k. This is a pension plan designed for you to open if you want, but you have to have an LLC, and you can't have more than you and your spouse as employees of that LLC. It's a very simple entity. In fact, NuView, NUVU out of Orlando will open you a solo 401k for about $500 last time I talked to them. Okay, not expensive, not hard to maintain. And now in a solo 401k, number one, you get to hold the checkbook and you get to write the checks and comply with the IRS rules. All right. Number two, you can contribute up to $62,000 a year. Not that I care, but when you open this solo, you have to decide if it's going to be treated like a Roth or treated like a traditional. In my opinion, you want it treated like a Roth. Only downside to that is you can't write off the contributions you make to the solo 401k. I don't care because I doubt you're going to contribute $62,000 a year to it anyway. If you treat it as a traditional, remember now when you take money out of it, it's tax-free. You can even borrow up to 50% of the account value, up to $50,000 a year. You cannot borrow money from your IRA. You can borrow it from your 401k. And here's the big one. Frankly, why I'm even talking about it is that deals in your solo do not trigger UBIT. So if you can get a solo set up, that's where you want to buy houses with owner financing. That's where you want to buy them subject to. And it can borrow money, non-recourse, just like your IRA can, but there is no UBIT. And the annual filing is very minimal. And frankly, it's just such an easy entity to operate. So you can check with NuView on that. Now, here's the problem with it. Some of you may have this problem. I have this problem. The solo 401k cannot have more employees than husband and wife. But if you have other companies with employees, the IRS is going to put you all in one great big basket. So you're not going to qualify for a solo 401k. Okay. Because of global publishing that my wife and I own, I can't have a 401k. Now, thinking that through a little bit, I can fix that because I can change the controlling interest in the company that's got the employees. If I don't have the controlling interest, then I'm okay with a 401k. Now, of course, you got to know if I change the controlling interest, I'm going to have some way to get it back if I want it. I'm not just going to give up controlling interest and hope everybody's going to do what they say. Sorry. So anyway, something for you to think about. Most of you will probably qualify for a solo 401k. Now, at the bottom of that page, something very interesting that I learned recently. There's a company called USTAGI. The guy's name is Joe Virey. I got it right down there for you. And he told me that as of September 22 of 2022, you can, well, first of all, if you're renovating a house, for example, you can now get tax credits for anything that you put into that house that complies with energy conservation. For example, your heat and air and your windows, for example. Tax credits means if I spend $5,000, I save $5,000 in income taxes. Okay, it's not a $5,000 write-off, it's $5,000 less I pay for income taxes. So that is huge for people that are renovating houses. And when you're renovating a house or you're building a house, those credits could wipe out a ton of your cash flow. Now, here's something else he told me. Cost segregation. This is what he does. That means he'll take a property, which I thought was all commercial property, and he'll come and they'll identify all of the assets that can be written off in a shorter period of time than the 27 and a half years that you write off for depreciation. That's huge because he tells me that whatever you paid for that house, give or take about 25% of that amount can be written off on 3 to 5 year depreciation which raises your depreciation through the roof and then lowers your taxes. It's up, you guys need to learn every way you can to lower your taxes legally. This is one of them. If you got a bunch of houses sitting out there, I mean, it doesn't cost them much. They don't even leave their desk, from what I understand, to do these cost segregation reports. Oh, by the way, I didn't mention, if they do the reports, well, let me see. It says here that they go back 3 years. That's on the stuff you put in the houses. You can do cost segregation on your properties anytime. I had them done on the buildings that I'm sitting in here, right here. I mean, it was something like $150,000 write-off, and he doesn't charge much. It's about $1,000. I'm speaking out of turn here. You better ask him, but about $1,000 per report. But he's got to come do this report for it to comply with IRS scrutiny. So if you've got rental property sitting out there, why wouldn't you contact him? It doesn't make any sense not to, right? Because you're going to be saved a bunch of taxes, way more than it's going to cost you to get these reports. You're welcome. I bet you didn't know that. I hope you took this screenshot now so you have his contact information. By the way, I did a podcast with him. So if you are not in my podcast, write this down. TheMentorPodcast.com. Go sign up for it, and you'll get notified every Wednesday when we're about to air one. And I interview some pretty cool people on this thing. And it's all archived on the site once you sign up for it. TheMentorPodcast.com is free. All right. So solo 401k is the second way you can operate tax-free. You can do the same things with it you can do with your Roth, but remember the different rules. You should treat your solo 401k as if it is your Roth and comply with all those self-dealing rules, even though you control the checkbook. So IRS says it's okay with me.